As always, we stick to our investment process. We've run a tried and tested process based around quality growth and momentum in the UK now, over 5 economic cycles, and that doesn't change. But what does change, though, is what qualifies as a quality growth and momentum stock during the cycle. And our stock screening tool, the Matrix, has been really good. I mean, it's been doing its job as a signalling tool and identified new and interesting companies that have become quality growth and momentum against differing backdrops. We hold around 47 stocks. It's been fairly consistent around that level. We like to run a concentrated portfolio where we really back our winners and back our conviction. And that feeds into the momentum part of our process where we run our winners. What we have been really pleased with that in a market that has been dominated by earnings downgrades, our portfolio has been really resilient. Earnings upgrades are quite hard to come by at the moment, and we've been pleased with the resilience shown in our portfolio. I'm not saying that we've been completely immune, but the quality really has shone in terms of companies who can protect those earnings and continue to drive market share. Another feature of our stock screening tool, the Matrix, is that we can really drill into the factors. We've certainly been paying more attention to quality factors, and we've been topping up names with high Matrix scores, some more defensive names, and we've been a lot more cognizant of valuation in the cycle. I'm pleased to say that we've had a better Q4. For the vast majority of the year, the market really hasn't distinguished between good companies or bad companies, and it's all been about the top down. Regardless of what companies said in earnings, smaller companies across the UK have been really punished. And in the final quarter of the year, we've seen that turn, and we've seen investors really start to care about quality again. And that's a really good environment for us. You know, we feel a lot more confident against this backdrop where the market has been reacting to good updates from good companies. And some of the best contributors across the quarter have been names which have been great all year, but the market just hasn't rewarded that. So names like Telecom Plus, like Discover IE, Alpha FMC and 4imprint, who have really produced some really good updates for the vast majority of the year, are now starting to be rewarded by that, with the share prices responding accordingly. We've added a new holding in FRP Advisory. It's a mid-market advisory firm with services across 5 business lines. It's predominantly restructuring, and despite the insolvency market being fairly subdued throughout its quoted life, FRP has done a really good job against a very quiet backdrop and growing market share. Arguably, with the higher rate environment and government support rolling off, then the backdrop has just got a whole lot better for this company. But for us, this is more than just a counter-cyclical play. We see a number of levers for growth as they provide solutions for the business across its whole corporate lifestyle. And the strategy is to broaden out across those service lines, and that will help develop the cross-selling and capabilities. It is a margin improvement story as the business continues to scale, and we expect to see bolt-on M&A from here. FRP has a really experienced management team with a really strong culture that they seem to do well of embedding throughout the organisation. And the talent that they have is highly motivated. The business generates a lot of cash. The balance sheet is really strong with negligible capex requirements, and the cost base is lean. And that all goes to help fund the 3.5% dividend yield. The trust exited our holding in Strix on the second profit warnings as the core kettles business is under pressure from Chinese lockdowns. And we're nervous around some of the expectations that they have for the water business. It made sense for us to step away from the stock given the lack of visibility in the near term. Dunelm has been a holding across the fund for a while, and what's really interesting about Dunelm is their performance, particularly in Q4 and indeed in Q1 2023. So this was a stock where the market had been really concerned about the normalisation in sales post-pandemic. But what we've seen from Dunelm is them really rise to the challenge, and they've continued to do well and really drive that market share. And this is because they've got a great management team and they're a great retailer. And it's down to a few things. They've continued to invest, and really this is paying off in their proposition. They've done two big investments into physical infrastructure and into distribution, and they've opened facilities in Davenport and Stoke. And this is really working for them. In the recent trading update, we've seen some really good top-line growth, some GM trends really helping to reassure the market on not only that their proposition is relevant, but that they're really reassuring on profitability. And because of all of this investment, they've got some really healthy tailwinds and cost efficiencies, helping them to perform really well into this year. And for Dunelm, it's not just about the investments that they've done into the physical infrastructure. It's really what they've done with the offer and that real range that they can offer across that value space with a good, better and best range. And they've broadened out into adjacent categories. And that means that for us, Dunelm are really becoming the home retailer of choice. Dunelm does trade on a premium to the sector, but we think that this doesn't reflect the quality or the growth of the momentum in the business. And the strong balance sheet offers a really attractive dividend yield alongside all of that growth. Well, for us at the moment, it's really been great companies doing well against a difficult backdrop. And you would expect that from us because of the quality focus within our investment process. And while the whole portfolio hasn't been immune from economic volatility, what we have seen from our management teams is some real strength in trading. And in a downgrade-dominated environment, our businesses have been trading really well. It's just that for the vast majority of the year, unfortunately, share prices haven't performed. And this comes down to high-quality businesses with great business models and great management teams. And this, again, is a function of the process where we're looking for high-quality companies with real barriers to entry, with competitive advantages and lots of visibility, which helps in this environment. What we have seen from a number of our companies is that whilst they've always told us that they've had pricing power, we've really seen that proven out over the past year. Over the past year, the strength in value really has been against our style. We stick to our process. We invest in high quality companies that can grow and maintain momentum, and that hasn't changed. It wasn't long since economists and strategists were predicting a really long, deep, severe recession. But it seems to be that there's been a new wave of confidence in January, and sentiment is better after some better macro data and indeed some good updates from some of the consumer stocks, which has been surprising. It may well be now that we're at peak inflation, and any declines in inflation will mean less aggressive rate rises. And that's really good for markets and good for quality growth and for smaller companies. We think every cycle is different, and there's always a range of economic outcomes. And particularly with the ongoing geopolitical backdrop, there may be some risk to this recovery. It could be the sense that the markets have gone too far, too quickly, and we may well see a resurgence of that value trade. Whilst there will be some variances in short-term style dominances, we'll just take this opportunity to remind shareholders that, smaller companies are a longer-term investment. And the ones that we're invested in, the high-quality ones with resilient earnings, are those that will still be around in 5 years' time. And smaller companies over the long term are great performers. And in that environment, there are a few things that smaller companies will benefit from. One is that valuations are much lower versus history, versus other indices, and indeed versus other geographies. UK small and mid caps looks really attractive at the moment, and there lies the opportunity. If you get lower than expected interest rate rises, then that's great for markets. We've seen a rebound in the pound versus the dollar strength, which is also great for UK markets. And importantly, we've seen fewer investors selling UK.